ideally, you'd want to put down 20%. So right off the bat, everyone's thinking, I have to get to 20%. That's ideally. The down payment amount, depending on the loan program, for a first-time homebuyer, it can be as low as 0% on a VA loan. More times than not, it's somewhere between the 3 and 3.5%, so the conventional or the FHA program. So you're already 16.5 to 17% lower. The bigger concern that homebuyers should have is the payment, not the down payment, the actual monthly payment that they have to make.
When you buy something, you typically have a conception of that thing, whether it was research that you did. I bought my cameras, right? I did research, maybe not enough research to figure out what was the sweet spot. I probably wouldn't have gotten that camera and probably got 2 of these cameras.
Okay.
Or function, something that's kind of in between that serve the purpose. And the reason why I say that is because this camera shuts off after 30 minutes. I talked about that a little bit.
Yeah.
And the same thing with this one. This camera is a very nice vlogging content creation. Camera doesn't shut off, maybe overheats and whatnot. But there's like 1, information overload. 2, there could be some misconceptions. I got to imagine in our business that probably happens quite a bit. Oh, well, I can't buy a mortgage without this. I can't get insurance, or insurance is going to be cheap. So when we're going through all of this stuff, and as we've grown into our career, like, assumptions are a problem.
Yes.
Like, what do we do? I don't know how you prepare for that, because I think that's just going to continue to get worse. You add in the element of ChatGPT, Claude, and in the all sorts of ways people can get information. So we're going to go back and forth on the misconceptions on the mortgage side of things. I'm going to bring insurance misconceptions. You'll bring me the mortgage misconceptions. And I think we'll find some sort of sweet spot that people can take the information that we hand off with.
Yeah, absolutely.
Let's go right into the first one that buyers, I think, still believe. And it's funny because I told you this when we prepped, that I'm a contrast. I try to think in contrast. Okay. So hearing this, that people think that you need 20% to buy a house, I'm thinking there's no way that everybody thinks that. But it sounds like they do. You don't need 20% down to buy a home. So where do you think this myth comes from?
So to back up a little bit, like right now between Google and the AI search fields of ChatGPT or Google Gemini, right now a lot of home buyers are trying to do their own research. All the power in the world to do that, do your own research. What I can tell you is that the internet, whether it's on your phone, tablet, or computer, the internet's going to give you generality information. From a home buyer perspective, a professional is going to give you specific information to your home buying scenario. And that's ultimately what you're looking to do.
Give me 2 examples. So right. Generic information, and then what information that you could provide.
Yeah, so how much do I need to put down?
Mm-hmm. That's generic.
That's a generic question. How much do I need to put down to buy a home?
Mm-hmm.
In most cases, what AI is going to say, and I've done it, done the search myself, it's going to say, ideally, you'd want to put down 20%. So right off the bat, everyone's thinking, I have to get to 20%. That's ideally. The down payment amount, depending on the loan program, for a first-time homebuyer, it can be as low as 0% on a VA loan. More times than not, it's somewhere between the 3 and 3.5%, so the conventional or the FHA program. So you're already 16.5 to 17% lower. The bigger concern that homebuyers should have is the payment, not the down payment, the actual monthly payment that they have to make. That's what they should be more concerned about than the down payment to actually qualify. So that's like one of the myths, trying to get away from. And I do think it is from years of mortgages where 20% was the common number prior to. The evolution of the mortgage world, mortgage products and programs has evolved. It is no longer just you have 5 options. Oh, you actually don't qualify for these 2. You only have 3. This is your best one. Some of the lenders out there have over 100 options that they have to narrow it in. And it varies by home type. So primary, secondary, or investment property. And then it also varies on loan program. you're a first-time home buyer, you're a repeat homeowner, that's going to change it. So the 20%, that's a generality that you'll get from Google search or chat GPT. It doesn't mean it's your specific scenario or a home buyer specific scenario. Quite frankly, it's not. In terms of an investment property, sure, yes, that's probably the only avenue that it has to be 20 or 25% for an investment property. But from a primary residence, absolutely not.
How many people have you ever run into a situation where people pre-disqualify themselves before talking to you? Like, oh, well, I don't have 20% to put down, or for that matter, I don't have 3.5% to put down. Do you ever run into those situations where you talk them off the ledge, if you will?
Daily.
Yeah.
It's daily. So I don't have the down payment. I don't have the closing costs. That's just the mindset, because a professional, and this is not something they'll find online, they may, but it's unlikely. But there are down payment assistance programs out there that are more times than not for first-time home buyers. Now, there's some coming out now that are for not first-time home buyers, which is great to see.
Oh, really?
Yeah.
Like what?
So one of the state agencies, specifically in Connecticut, the Connecticut Housing Finance Authority, has a new program coming out called Next Move, and it's actually for non-first-time home buyers, and they can get down payment assistance.
Wow.
Circumstances change from when you bought the house to the current. So it's being launched officially on June 22nd. For more information, I'm happy to answer any calls from buyers, even from the realtor professionals, because it's not, it's at the very entry level of being announced. It's just got announced at the start of the month.
I think that we just uncovered a misconception that you could only get a first-time home buyer credit or down payment assistance as a first-time home buyer.
Correct.
That is something I never knew until now.
Yeah.
That's good information for people to know.
Yeah. Yeah. So like that's and it doesn't need to be 20% down.
Sure.
So
And that also doesn't have to be 20. Wow.
Nope. Yep.
Ideally 20%, right, is the research most people are going to come across. And then that's not necessarily the case. It's funny, right? Because we just had PMI removed. I knew that we had PMI. I didn't realize we didn't put at least 20% down when we bought this house.
Yeah.
We put a sizable down payment, but we didn't put 20%. So PMI just got removed. But why is 20% the ideal, not financial advice, ideal scenario versus a 3.5% FHA or now this new program that doesn't have to be 20%?
Yeah. So if you're not putting down 20% on a conventional loan at time of purchase, so when you're buying the loan, it's starting at 80%. So that's the 20% down payment. Therefore, private mortgage or PMI gets involved on a conventional loan. I'll go into the FHA counterpart, and they're likewise MIP. I love how it's the same letters, just in different order.
It's just different.
But for a PMI on a conventional loan, if you do not put down 20%, that kicks in. What that is, and this is ironic enough, it's default insurance. Mm-hmm. And that's what you're paying the premium for, default insurance.
That protects the bank, correct?
It protects the loan servicer, who's providing those funds in the end. Yes. So that's a protection. Now, that gets based on credit, the loan program type, all that stuff. So those are the two primary factors, is going to be credit and down payment. Because if you put down 3% versus 5% versus 10%, there's different tiers.
Sure.
And that will tell you, and when we get the output information, as to what the actual coverage is going to cost on a monthly basis. Now, another misconception when it comes to private mortgage insurance is actually that if you don't put down 20%, that's when it kicks in. But if you do close on your mortgage with less than 20%, PMI, unless you apply to have it removed, actually falls off at 78%. But also, there's another sub-misconception, is that you'll hear all the time to always make, do the very best you can to make one extra monthly payment of principal and interest to have your loan to value reach 78% faster. In most cases, the mortgage insurance companies go off the original amortization schedule, because that mortgage insurance company is not getting your loan balance. Mm-hmm. That's two different companies. And the loan servicer can't share the loan balance information with someone that's not the owner of that loan. So everyone's like, oh, just pay it down. You'll get to 78% faster and have your PMI fall off. The MI company will never know that. They actually go off the original amortization schedule. So what that means is if you make your minimum payment, it's going to fall off on whatever year that is on the amortization schedule, which you get at closing. Yeah. The buyer gets at closing. So that's a sub misconception, is to make the extra payment to have the PMI fall off faster, you can make the extra payment, but you have to contact the loan servicer, say, hey, I feel my house has gone up and I've paid down my mortgage. I feel like I'm below the 78%. I would like to have my PMI removed. What are my next steps? That's a misconception after the closing on PMI.
That's interesting, because I was just thinking, as you're saying this, that our value of our house, when I was comparing from when we bought it to what it is now, I was like, oh, it's a no-brainer that they should be able to remove PMI.
Right.
So it sounds like there's multiple ways to do that. That sub-misconception by paying it down, but there's some other steps that have to involve with that. Or the inflated pricing housing market also can naturally, if you're paying attention to it and you know, hey, I have this, and because otherwise, like if I never called, I'm paying PMI now for another 2 years probably.
Yeah.
Right. You know, so I like that you said that there's a sub-misconception that you don't have to, or not necessarily have to pay a little bit more to get that down. PMI is a big deal. Like, I mean, in some cases, it could be a couple $100s, and with how expensive things are,
right?
You know, you could pop that back into into your wallet.
So the FHA MIP, so the conventional loan equivalent, putting down, if you do anywhere from the 3.5% minimum down payment to 10% down, it's on there for the life of the loan.
Mm-hmm.
Okay, if you put down 10% or greater, it's actually only on there for 11 years. Then it does fall off. But that's a different structure than what the conventional is. So if you do 3.5 to the 10, 9.99%, it's the MIP is on there for the life of the loan. So as long as you have that loan paid out for 30 years in most cases, you have that amount built into your loan.
And it has to stay on
until you refinance. Yeah,
wow.
It doesn't fall off. So then otherwise you could either refinance into a conventional loan and have it come off and never have it for the life of the loan, the different structures. Or if you did at least 10%, it's automatically going to fall off in year 11. That's not a LTV or anything. It's based on that down payment. In year 11, it's falling off.
And LTV is loan to value, correct?
Loan to value.
Yeah, loan to value. Okay. Mortgage misconception number 2, the biggest down payment always makes the strongest offer. I didn't think that was a I would have never thought that that the biggest down payment always made the strongest offer. I guess I just assumed that, like, you follow the money, right? Most people follow the money. Hey, so what makes an offer strong besides the down payment, right?
Yep.
So if the biggest down payment always, the misconception is the biggest down payment always makes the strongest offer, what makes a strong offer if that's the misconception, if it's not just that?
So the biggest thing is, if you took, and this is just for an example to help kind of work through it all the way through, is that if you took the same exact offer, same purchase price, same contingency, so what they're doing for inspections, appraisals, mortgage commitment, all of that in that contract, it looks exactly the same. And the only difference is the down payment. And just for round numbers sake, we'll make one be 10% down payment and one be 3% down payment. What makes a strong offer is verifying with the lender what that actually means. So in some cases, that 10% down payment buyer, that might be the only way they are qualified, is they have to put down 10% to be qualified or pre-approved or pre-qualified in order to submit that offer. Now, depending on that information, depending on what the homeowner's insurance quote was estimated at, what they verified for real estate taxes. Because the biggest thing with real estate taxes is it pulls in the information off the town tax record. Well, if that current homeowner, depending on the town or city, if that current homeowner has an exemption, that's being applied into that number. That does not automatically carry over to the new homeowner. So they may have higher taxes than the current homeowner has.
Wow.
So there's different deductions. There's veteran deductions. There's elderly deductions. There's disabled deductions. And you don't have to just qualify for one. Earlier this year, I had the current homeowner had two deductions on there, or two exemptions on there. They were a disabled veteran. That does not carry over to the new homeowner. So the taxes were going to be higher for this property than what was listed for the new homeowner.
Interesting. Sorry, I didn't mean to cut you. I just found out, I was talking to a VA buyer recently, and that they don't pay taxes. They don't escrow taxes Is that accurate? He was like, yeah, he's like, I'm a disabled vet. I don't have to pay taxes on the property.
That's an exemption.
That's an exemption. So that's what you're describing there.
Correct.
Got it.
Yeah.
Got it.
So they can apply for it.
Wow.
More times than not, it's up timing based on for the town or city that what I've seen most common is you got to apply by July 1st for have it to be effective. But that is a possibility. And that completely changes the qualification for the loan and, the debt to income ratio, the DTI, and then the interest
in favor, right? I would assume in favor, right?
Absolutely.
Yeah.
So going back to the example of 10%, like if those numbers, and say it's a debt to income ratio that cannot exceed 50% on a conventional loan, and they're at 49.7, and there was an exemption that was not calculated into being held onto the new buyer.
Yeah.
That 10% buyer may now be over threshold once they verify the taxes in the middle of the loan process after offer accepted. Now you got to figure out how to get more down payment money to get back under. Pay off a credit card, pay off a car loan, get a gift, pull money from retirement. That's a completely different aspect and can become very stressful for the buyer that they may not want to do that.
Yeah.
They may not have the opportunity to ask for that. Now, the 3% buyer, that 3% buyer could be at a debt to income ratio sub 45%, ideal borrower, have the assets completely liquid, ready to go, no questions asked. So now at that point, now that when they have more information from that 10% versus 3% buyer on paper, because that homeowner, the current homeowner, is not getting those funds sooner. That 10% versus 3%,
right,
that's being held by the attorney. They don't see that money until after closing.
Yeah.
Key word is closing.
Right.
It is now more likely that the 3% technically home buyer may be faster, more advantageous to achieve the closing table than the other. So it is, just because it's a higher down payment amount doesn't necessarily mean, if you're just looking at the paper information, does not necessarily mean 10% down payment's a better offer than the 3%.
So as a buyer, right, like, how can I go into my in this specific scenario, how can I go into potentially buying a house knowing that even though I might not have the strongest offer, I don't have to be discouraged that I might not buy this house, especially in this market where a lot of people are getting outbid.
Mm-hmm. Yeah, I mean, the strongest offer is based on every buyer's scenario. They have to feel comfortable with it too. So when someone says, what's a strong offer? It's what that buyer feels most comfortable with from a presentation perspective, not only from their own finances, but from the realtor and the lender's perspective. Like, this is what's going to change. Your principal and interest is going to stay the same for the next 30 years. What can go up is insurance and taxes. Right. We want you to be aware of that. Just because a buyer says, I want my payment to stay under $3,000 for the month, including everything. Well, that's what it could start at. Doesn't mean it's going to go. It doesn't mean it's not going to go up, because taxes and insurance in most cases and historically have proven that those are going to go up.
Right.
Got to account for that. So when we say, oh, my monthly payment, I don't want it to go above $3,000. My next comment is, we can start there.
Yeah.
However, it's not going to stay there.
It's not likely. How often do you see in your 14 years, almost 15 years of doing this, that a offer that's not the strongest, highest offer, the most money offer, win the bid?
In my experience, I don't get all the details of when it is not accepted, what the difference is. Sure. It's a realtor can speak more to that when we have a realtor guest on there. What's disclosed, what's not disclosed, as to what won and lost the offer. What I can tell you is that I know I have won clients' offers because I've called the listing agent on my client's behalf to explain their scenario and the details that I can share. And then, quite frankly, because the listing agent has called me back, or my buyer's agent is calling me back to answer questions that they're going to share with the listing agent, I answered my phone, whether it's the phone call or a text message or an email. Just that simple mindset of providing a clearer picture to the listing agent / seller, that gives a more sense of comfort to accept an offer that's 5, 10, 15,000 lower that, well, they really can't confirm the information. So you're just going off the dollar amount and doing one of these, your fingers crossed and hoping it closes. The theory is that, I would assume, and once again, we can confirm with a realtor, is that the listing agent's fiduciary responsibility is to provide the best possible offers to the client with explanation for the seller to make an educated decision on which offer to accept. Part of that is from the lender.
Yeah.
Because the piece of paper is probably 50% of the story on a pre-approval letter.
Yeah.
So if that. So having more information than just that letter, I think is crucial. So a strong offer is supported by not just a pre-approval letter,
Right.
but the lender, him or herself.
Roger that. So,
And to go into that too, what is a common misconception that it happens that early on from an insurance perspective? Because they may be looking at, I have clients that are on their 13th or 15th house now looking at it.
yeah.
That's 13 or 15 different roofs, different home styles,
Right.
different build ages. From a pre-approval and offer acceptance, what does that look like from the insurance side of things? Like, how early can an insurance misconception happen for a client that's a first-time homeowner?
It's
How
funny.
early can that happen?
I think the assumption can happen right away, right? Like, oh yeah, like I'm gonna get this insurance quote. My house is $400,000, $500,000, and when they get the quote, they see that the replacement cost coverage is either way higher than the purchase price or way lower than the purchase price. So let's just say $500,000 home, $500,000 house, carrier A, $400,000 replacement costs. All right, well, let's start talking about where that house is. Is it in Salem, Connecticut? Is it in Mystic, Connecticut? Going to be completely different. But what's not spoken to when it comes to looking at houses is what is it going to cost to rebuild? Yeah. So when they see that number, and I often deal with it, is, well, my house is worth this much. People aren't factoring in the cost to rebuild. And I think we talked about it a little bit, but there's each carrier has a vendor that they use and to calculate how much is it going to cost to rebuild? What's the labor going to be? What's it going to cost to re-roof it? They factor in all of that stuff and along with a bunch of other things. And people don't know that until they speak with an insurance agent.
Right.
So oftentimes it's the first thing that I say, hey, this is what you're going to notice. You're going to notice that your purchase price is X and replacement cost is going to be completely different one way or the other. If you're shopping with 10 different carriers, you're going to get very confused. But don't let that scare you because it doesn't mean it's a bad thing or a good thing.
Now, how does that change from after purchase? Like, when they're doing that renewal, are you, like, as an insurance agent, do you have to rerun that replacement cost? Because I'm assuming, especially the last 5 years here, we've seen that replacement cost with, the prices of materials for home builders and contractors has skyrocketed and maintained, unfortunately, that, everyone thought would come down. What does that look like from a renewal perspective too, not just from the purchase, but for renewal?
That's a good question. Yeah. So a good agent will make sure that there's a couple endorsements added to the policy. Inflation guard is one of them. There's a handful of carriers that will go up 3%, 5%, 1%, 2%, depending on the specifics of that endorsement. And for language purposes, endorsements are those that you just add-ons to the policy, changes to the policy, optional coverages, if you will, to add on. So a good agent would say, hey, listen, in this market, this is what's going on. I said this, I think in either the first or the second episode that we did, where since 2020, lumber has been, the cost of material is about 30% higher than what it was. So a good agent will add that endorsement because at renewal, it is going to keep up with inflation at the percentage of what you put in there. So if it's 1 or 2% based off of the market, you would try to include that on there. Now, agents should do, and I truly believe this, you should do what's called I call it a account health checkup. Okay. Has anything changed? I know a lot has changed for me in the last year. I've had a new baby. Has anything changed for your lifestyle? And that opens up the discussion to talk about the different changes with replacement costs and such. So yeah, a good agent should do it. There are carriers that run it on the back end of things, and it's something we use what's called a cost estimator, which from time to time you probably see where you need the estimated, especially if it's less than the loan amount, right?
Right.
If the loan amount's $395 and the replacement cost is coming in at $275, you guys need that to say, hey, is this covered at full replacement cost, right? So a good agent one is going to make sure that that is taken care of ahead of. But at renewal, I'm going to call you and say, hey, listen, let's take a peek at this. We have a full service team that does that, and we make sure that the client knows that their costs are going up, because you don't want to be underinsured. You don't want your house to, God forbid, burn down and then, I can't have the house rebuilt. Now, there's also two things that are attached to these policies, or you can add on as an endorsement, expanded replacement costs.
Okay.
So you can go up to 25%. So if I have $100,000 replacement cost, a 25% cushion above that, right? You could go 25%, 50%. Some go as high as 200%. Some will go guaranteed replacement. And if you have guaranteed replacement, then that's going to keep up with it from year to year on a policy sense. So to answer the question, yeah, I mean, it is definitely something that agents should do. It is something that I do. I talk to you, hey, listen, this has changed. You have had your policy with me for 10 years. You're paying, your replacement cost says $300,000, but look at this market. Look at what it's actually going to cost per square foot in this area.
So, hey, Paul, I know we were talking about when to get the insurance agent involved, and I'm learning more and more. It could be sooner, but what I experience is that when I say, oh, talk to an insurance agent, see what you can get for a quote, the most common answer they said is, well, this is the cheapest one I could get.
Yeah.
Is that truly the best? Like, oh, cheapest is the better? Like, I would relate the cheapest to value for me. I would have them say, well, that's the most inexpensive, because insurance is giving value.
Sure.
So what is the misconception to say cheapest is the best?
I think that just is how heightened people are with their money. I think really, and the cheapest doesn't mean it's wrong. So how people value their money, how people are looking at their expenses, like we talked about the DTI and what people need to buy the house, and could it push them over the limit? The cheaper pricing is usually attractive because it's going to get them to the finish line. I think the difference between our businesses is that I'm in consistent communication with these people year over year over year over year. You get them as a handoff from a realtor. You deal with them throughout the process, walk them through the finish line. And they might come back to you via referral for another customer or a potential refi, right? With me, people are with me for a decent amount of time. I'm talking to two people right now who've been insured with me for over a decade, which is great. And that's good for me, right? But the piece that folks don't understand in the beginning of the process, that the cheapest price, you also want to look at the reputation of the carrier. Are they AM Best rated? What's their financial stability? Can they pay the claims? Those are big questions to ask. And if you don't have an agent to talk to you about this stuff, it can go overlooked. You can get this policy and hopefully nothing ever happens. But if it does, can it be paid out? And so I don't know if I don't want to speak bad about the cheapest price, right? I find rates for people that are pretty cheap. I'm transparent of very much that. This is the company, this is their rating. You take this information. People want security. And that's what I'm trying to sell. I'm trying to sell security. Can the person get this policy, get a good rate, competitive, let's just say $1,500, $1,800, and be confident that if there's a loss, this insurance company is going to take care of them. Mm-hmm. And I had somebody tell me this the other day. I was saying, hey, listen, I can shop your insurance. You've been with this company for 15 years. Your rates are pretty high. And she's like, I'm going to stay here. And I said, fine. Can I ask why? Because they've been very good to me. I had a couple losses in the last 15 years with this company. One's pretty sizable, over $60,000. Wow. And another one over 30. And they were good to me. So I'm willing to spend the extra money. I don't care if it's $1,000, $2,000. Now everybody's not in that same situation.
Right.
And I think that's the hardest piece. Because I talk to people who will spend $100 less a year for the same kind of coverage.
Right. But you have others that are willing to pay a premium.
Yes.
Because of that experience.
Correct. And that's what it boils down to. The experience of the person you're doing business with. Now, here's the thing. Again, I only can speak from the perspective of an independent insurance agent. I write my own insurance. I know what to look for. But if I wasn't in this seat, I don't know how I would perceive it as going direct to a company, going to a website, www.insurancecompany.com, getting that quote and saying, oh, yeah, that's perfect. I want to do that. All right, cool. What's the process of that relationship that you're going to have with that company? And the difference is, and what I try to pitch is why the cheapest quote's not the best quote is because you have me. I can look at this again. I could look at this in a year, 2 years, 3 years. We are going to do a consistent account review. The direct-to-consumer model is not doing a account review. At least I haven't seen it in my 15 years. Mm-hmm. So when you ask the conception on pricing, the cheapest quote is not always the best quote. It's not necessarily just because of the carrier and the pricing, because for the most part, carriers are pretty uniform, minus a couple of endorsements and what might set them apart.
Right.
It's the agent behind the scenes, and that's typically how I try to position it.
Now, to wrap up this misconception as well, because you're talking about, cheapest, and from what I see and hear on the, whether it's the radio or watching podcasts, you get the advertisement in the middle of it, and whether it's the characters that they have, Mayhem, the Gecko, Flo, some of the other ones, Jake from,
State Farm,
all those, they're talking about that they'll be there and they have inexpensive costs. Mm-hmm. And that is just force feeding marketing into a person to 100%. Believe that. And I think that was, part of the conversation we were talking about earlier. When a client is doing their Google research, AI is telling them it has to be 20% down. Well, that force feeding of marketing is saying, oh, I should go with one of those because they're constantly seeing and hearing it. They just assume that belief. It's a little different than going on AI or Google, but how does that play into it too?
Yeah. Well, listen, I think, I think the old adage of one of the bigger carriers, the direct model was 15 minutes can save you 15% or more.
Yep.
I don't coin that. You can look up the company who does that. But, there's variables, right? Like, that's like saying, hey, like, I can go to this bank, I could go to this officer, and you can potentially get approved at a X credit score for the lowest interest rate. Okay. That's attractive. So these companies are doing their job getting people through the door, right? They are. They know how to market. They know how to get people knocking at the door. But there's other things. What's your credit history? What's your insurance history? Where do you live? What's your loss history? What's the environment? And going back to the misconception on replacement costs, and I don't know if I touched on that. We did touch on the replacement cost and the market value of the house.
Yep.
Market value, you're looking at the house, the land, the location, the school systems. That's what you're buying when you're buying your house. Replacement cost is the cost to rebuild the house. Okay, so let's just say the replacement cost coverage is a X amount of dollars of premium. Everything else that's calculated into that premium are those other things. What your credit is, what your history, your loss history is, the pool, the stuff like that. So all these companies are doing what they need to do to get people through the door. In my opinion, especially on the direct side of things, you as a consumer, you kind of waste your time unless you're okay with it, but you kind of waste your time going to one company's website, another company's website, 3 companies, 4, 5, sometimes 6, sometimes 10 different companies to get a individual rate when you could have just used one person to do it for you. Right. And when you think about the value add, now listen, I'm not always going to win. Not always, insurance isn't a one size fit all kind of thing. So I'm not going to win 9, all the time. But I do know that I can position myself stronger based off of knowing that, hey, listen, I'm going to look at your auto insurance. I'm going to look at your homeowner's insurance. I'm going to look at anything else that you have in your portfolio, because one thing, and I'll wrap up with this last conception, because there's a lot of other things that we could talk about. We'll share for a different episode. One thing that people don't think about is their car insurance when it comes to homeowner's insurance. Here's why. I live in Salem, Connecticut. I'm moving from Salem to, let's just call it Glastonbury. What changes with that?
Different community.
Okay, what else?
Your commute.
Your zip code.
Your
Your
zip
commute,
code.
right? So let's say, all right, I don't think about changing my car insurance from Salem to the new garaging address right away when people are like, oh no, I just want to look at the homeowner's insurance. Well, Colin, just so you know, when you close on your house, you're going to have to let your car insurance company know that you have a new address, which is subject to rate change because of the commute now. I was in Salem, but now I'm going to be commuting into Glastonbury or vice versa, depending on where you work. There's that. There's the zip code that is rate bearing because is it in a higher dense community? Or is there more traffic in those communities? And the answer to that's probably yeah, right? You're going to see there's going to be more accidents likely in a place like Glastonbury, Connecticut, or Hartford, Connecticut, than there is in Salem, Connecticut, just because of the amount of traffic that's coming in and out of.
Well, there's major state routes going through
major
there.
State routes, right? And people aren't thinking about that because they want to get the deal done on the home. But most carriers offer a substantial discount when you bundle the auto and homeowners insurance. So back to DTI, if $1,800 is putting you over the limit, homeowners insurance, if $1,800 a year is putting you over the limit for a closing on your house for DTI perspective, well, let's wrap in the auto insurance and it's going to knock off a percentage and it puts you back into the game. So it is something that people don't think about because they think that, and oftentimes I see people run into where their cars are still where they are and they move. Something happened to me, actually. I didn't even think about it. When I bought this house, I forgot to change my registration. I got pulled over a couple years ago. They're like, yeah, your registration's lapsed. I'm like, that's impossible. How's it lapsed? And come to find out, I never changed it because when I bought this car, the car I have now, it was attached to the other address, even though we lived here. They never updated on that side of things. So those things kind of happen. So it's important to know that you should look at all lines of business when it comes to that.
So the biggest thing that we've talked about today, it sounds like, and this is not financial and legal advice. We're not making this mandatory, but from our perspective, from this discussion we just had, what we're saying is do your research, but truly talk to a professional. Because the one thing that you and I can commit to, that every client we talk to, you had said it best, we're not going to win 100% of the time, but what we're going to do 100% of the time is provide the value and education to give them the information to make an informed decision.
Yes.
That's what we're saying, and that's what we're trying to communicate.
That is 1,000%. And I'm the first person to let you know, call me a poor salesperson. Like if some of the bigger salespeople, podcasters and Alex Hermosi or whatever heard me say something like this, they'll probably look at me like I have 10 heads. If I'm not winning, I'm going to let you know. Like if you give me a pricing to compare to and it's that much better, I will be the first one to say, hey, listen, you go that direction. But I'm going to check in on you in a year at your renewal. I will, because you had a good experience with me. I had a good experience with you. Let's give it another shot. And I'll be the first one to let people know that.
Yeah, I agree. Apples to apples comparison. Let's take a look at it. And if it's truly that's the result for me.
And I'll leave you guys with this and we'll wrap up. Insurance isn't just covering your home. It's protecting your livelihood. It's protecting what you make every single day, your earnings, to pay for the lifestyle that you live. And that's what it is. It's not just, oh, I'm covering my house. It is everything that you've worked hard for in your life that you built up to this moment to have covered. And to me, that's what it boils down to. So these misconceptions are important to debunk, if you will, right?
Yeah, absolutely.
These myths, it's important to debunk. And that's why we're here. We're here to hand off that information, not just to each other, but to our listeners. So guys, thank you very much for joining us. This is episode 4 of the Handoff. Make sure you like, subscribe to the channel, and we'll catch you guys next time.